here again uh, for another exciting session. Today, we are fortunate to have our very own alumni, Aryan Chandel, who is graduated from HR College in 2022. And from there, he went on to work at JP Morgan Chase in investment banking. And today, he runs his own trading fund and across global crypto markets, building strategies, automating execution, and managing risk in the real time. And we are fortunate to have him here because he is here today to share what he wishes he had known in the first year. So, Aryan, we welcome you, and the floor is all yours to share your thoughts, your understanding about the market, about the cryptos, and about the automation. Thank you so much, Aryan. Floor is up to you.
Thank you. Thank you so much, sir, for that intro. And I'm very glad to be addressing this first year for these first year students because, like you said, I really wish someone would have told me all of this that I'm going to share today. When I was in first year, I think I would have been doing much better than what I'm doing right now. So let's start with this session. Just give me a second. I'll share my screen. Yes. Can you guys see my screen?
Yes, Aryan, we can see the screen.
Perfect.
You can do the
Yeah.
change the mode of presentation. Yeah, it's proper now.
Yeah. Perfect. Perfect. All right. So the topic for today is the future of finance, AI, crypto, and quant trading. So 5 years back, when I was in first year, finance was not at all how it is today. Over the last 5 years, finance has drastically changed with all these new technologies that have come into the picture. And that is what we are going to address today. Now, before that, how many of you have used Instamart or Blinkit or Zepto or any kind of those apps? You can tell me by the raise of your hands. Okay, a lot of people have. Have you ever noticed that the price of all the items that are there on those apps, they keep changing based on the time of day, the time of the mobile you're using to order, the total value of your entire order. Now, how do you think the price keeps changing? It happens because of the use of machine learning algorithms. All right. So those same machine learning algorithms that are used to price those items in those apps, they are also used to price the shares, the bonds, the debentures, etc., which we see in finance. Okay. So, like I was talking, today finance is completely different. Back in 2020, 5 years ago, 6 years ago, the number of orders per day on NSE, which is the National Stock Exchange, was about 14 million. Today, it is 300 million, right? And the amount of orders that are executed by algorithms has also increased drastically. Earlier, it was somewhere close to 20-25%. Now it is close to 60%. All right. And even with crypto, when crypto started back in 2013, 14, there was hardly any volume. Even in 2019, 2020, 2021, there was not much volume. But today, the annual volume is over $30 trillion. And all of that is possible mainly because algorithms are being used to execute those orders. Okay. Now, how many of you have a crypto wallet today, as of now? I don't think anyone does. Okay. Now, today we're also going to do one interesting thing, which is today we're going to make our own crypto wallet and we're going to learn how to use it. But before that, I want to understand whether you guys know the technology that is used behind crypto. We all have heard about Bitcoin, Ethereum, etc., that a lot of people became billionaires by buying crypto, etc. But what is the underlying technology of crypto? That's the thing that you need to know about to actually do well in this space. So, can anyone tell me what do they understand by blockchain? Anyone who can unmute themselves and tell me what they understand by blockchain? You can try, even if you don't know, you can try. Else, I will just pick someone randomly.
Hello.
Yeah, please tell me.
So basically it's like a block of something three types like एक उसमें एक कुछ तो रेफरेंस नंबर होता है वो पर्टिकुलर ब्लॉक का एंड देन सम इंफॉर्मेशन एंड आल्सो समथिंग तो वो ऐसे बहुत सारे ब्लॉक्स का एक सीक्वेंस होता है जो एक ब्लॉक का थर्ड पार्ट होता है वो सेकंड का फर्स्ट होता है लाइक दिस तो वो ऑल आर कनेक्टेड तो इवन इफ
Very
वन
good.
गो अ डिफरेंट बिट तो पूरा चेंज हो जाता है और क्रैश हो जाता है लाइक
That is very correct. Not exact, but very correct. Anyone else who wants to give it a try?
Blockchain is a decentralized network and it handles a multiple transactions that are visible to the who are investing in that in crypto.
All right, very good. So the essence of blockchain is decentralization. What does decentralization mean? Right now, suppose you deposit 1 lakh rupees in your SBI bank account. Only SBI knows that you have your money with them, right? No other third party can verify that, right? Only SBI can tell you that, yes, I have your 1 lakh rupees. But imagine a world where everyone knows that your 1 lakh rupees is with SBI. Tomorrow, SBI cannot come and tell you that I don't have your money because everyone knows it, right? Even if they come and tell you, all the people who are there, they'll say that it's not true. They do have your money, right? And that is the basic concept of decentralization and of blockchain. What you're trying to do is basically spread the trust. Okay. Right now, when you deposit money in your bank, you're only trusting the bank. But when you tell everyone about it, you are trusting everyone that when the time comes, they will speak in your favor, right? And majority of people will do so. So instead of having one central party which approves or disapproves any statement, it is spread across everyone to approve or disapprove, and the majority wins. That is the basic concept of blockchain. So, like one of you answered, there are blocks that are connected to each other. That's why it's called a block chain. It is connected through a chain. And once a block is formed, it the data in that block is shared with everyone who is there on the network. All right. So suppose 10 million people are there and they have their crypto wallet on, say, Bitcoin. Each one of them will get to know that, okay, so and so transaction happened, and it is recorded in all of their machines. So tomorrow, if someone comes and tells that, boss, that this never happened, they all can come and say that, okay, this did happen. So what this does is basically it removes your need for trusting a central third party. Okay. Next, we come to smart contracts. Does anyone know what is a smart contract? Anyone who wants to give it a try? Okay, no worries. So everyone knows what a contract is, right? For example, your rent agreement, right? In which you say that, okay, I am going to stay in this house for these many months and I'm going to pay this much rent, this much deposit, this much maintenance, etc. And the owner and the tenant, they both sign that contract and they promise that we're going to follow this. But what happens if one of them does not follow it? It becomes very challenging for them to force them to follow it, right? You can go to the police station, you can go to the court, but it involves a lot of hassle. Now, what a smart contract does is that it binds both the parties to make sure that the contract is fulfilled in any case. So, for example, I enter into a contract with a person saying that, okay, today I am going to borrow 1 lakh rupees from you, and for the next 10 months, I am going to pay you 10,000 each month, and I'm going to repay you like that. And then in the last month, I'm going to pay you 10,000 extra to compensate you for the interest part. Now, in without a smart contract, it becomes very difficult to force it. But with the smart contracts, what happens is that your wallet, or suppose your bank account and the other person's bank account, gets linked, and this contract gets applied on both these accounts. So what's going to happen is that on the day the contract is made, 1 lakh will be transferred from bank B to bank A, and then every next month from bank A to bank B, 10,000 is going to get transferred. So what's going to happen is that you don't need to manually do it, number one. Number two, no one can back out from it. Once it is done, it's done. You cannot change a smart contract. That's the whole point of it. That once it is deployed on the network, it is deployed. You cannot change it. So that's the point of smart contracts. Now, is there anyone who did not understand any of these two topics? See, this has to be a two-way conversation. A one-way conversation will neither help you understand it nor will it be interesting. So it has to be a two-way conversation. So if you didn't understand anything, please tell me. Or if you want me to repeat anything, or if you want to talk about something.
Sir,
Yeah, please tell me.
what if in a smart contract both the parties mutually agree that they should not perform the contract?
So the whole concept of smart contract is that once it comes into the picture, once it is deployed on the network, you cannot go back. Okay. Now that's why what happens is that every smart contract is deployed with an expiration date. Okay. So once that expiration date is over, then you again decide whether you want to start it again or not. But once it is deployed, it is deployed. It cannot be changed. You can deploy another smart contract that negates the effect of the earlier one. Okay. So for example, let's take the previous example. So the person paid me 1 lakh rupees and I'm paying him 10,000 every month. In the fifth month, me and him have a conversation, and he tells me, "Okay, just pay me 50,000 now, and we can stop the EMI." Then what we'll have to do is that we'll have to deploy another smart contract that will send money from his account to my account as soon as he receives it. So that will negate it. All right, till the expiration date. But once it is deployed, you cannot cancel the first one. You can deploy the second one and then negate the effect of the first one, but you cannot cancel it. That's the whole point of smart contract. Okay, now we will move ahead with the layers of crypto market. So in the crypto market, there are essentially three layers. The first layer is the spot market. Now, what does spot mean? It essentially means on the spot. Okay, you pay money today and you get what you're supposed to get today on the spot, hand to hand. Okay. The next is derivatives. Derivatives, the price of derivatives is based on the price of spot. So, for example, the spot price of Bitcoin is, say, $100, and the spot price of Ethereum is, say, $10. So, the derivative price of those two tokens, for example, the future price of Bitcoin and Ethereum, will be based on the spot price. So, if the spot price goes up, the price of the derivatives will also go up, and vice versa. If it goes down, the price of the derivative will also go down. The third thing is DeFi, which is decentralized finance. Okay. Now, there is there is a distinction between decentralized finance and centralized finance within crypto also. So you must have heard about a lot of crypto companies. How many crypto companies have you guys heard of? Anyone, if you can name. We see a lot of ads these days. If you can name anyone in the chat. Uh, None. I think there are a lot of Indian companies also that have been in the news recently. For example, CoinDCX, yes. Another one that is pretty famous, Binance, yes. CoinSwitch, right. So these companies that you guys just answered, CoinSwitch, Binance, Coinbase, Delta Exchange, etc., they are centralized exchanges. Whenever you are depositing your crypto in these exchanges, you are not owning it in your own crypto wallet. You are owning that crypto through their crypto wallet, right? And that is why they are called centralized exchanges, because all the crypto is on at a central position, which is that exchange, whether it's Delta or whether it's CoinSwitch or Binance or Bybit, OKX, whichever, right? But on the other side, if you have a crypto wallet in your own computer, or if you have a crypto wallet in your own phone, that is decentralized finance, because it is not at a central position. Everyone is having their own crypto wallet, and that crypto wallet is storing your crypto. So that is the difference between decentralized finance and centralized finance. Centralized crypto exchanges will have the crypto in their own exchange, like Binance, Delta Exchange, etc. But DeFi, decentralized finance, you will have the crypto wallet in your own phone or laptop, and that is where you'll own the crypto. So that is the main difference. And recently, because of so many hacks that are happening in the crypto space, you must have heard about the WazirX hack that happened, I believe, in 2024, about $200 million or something like that. Because of such hacks that are happening, people are storing their crypto not on the exchange but with themselves, because it is much safer to keep it with yourself rather than keeping it with another entity which may or may not keep it responsibly, right? So that is why today we are going to learn how to make your own crypto wallet. It is very simple. I will show it to you on my laptop, but you can do it on your phone also. Just give me 1 second. Yeah. Can you guys see my white screen? Just give me a yes or a no in the chat. Perfect. So just go on the App Store or the Play Store and download either MetaMask or Trust Wallet, either of the two, or Phantom Wallet. Download any of these wallet and give me a thumbs up in the chat. This is what MetaMask will look like, something like this. And Trust Wallet will look like this. And Phantom Wallet will look something like this. Download any one and give me a thumbs up. I'm waiting. And if you're on your laptop, you can just download the extension. And this is what the extension will look like. Now, what you have to do is, since you do not have your own wallet, you click on Create New Wallet, and you can use a password. And you click on Continue. I cannot see a lot of thumbs up in the chat, very few compared to the number of people who are there in the call. Once you have made your wallet, it'll look something like this, right? And it's going to ask you to back up your secret phrase. Okay. Now, this secret phrase is basically what is used to recover your wallet in case you forget the password. So you must have heard that a lot of people have lost their crypto wallets, or they have lost their crypto hardware wallet, and they're not able to recover it. Why does that happen? That happens because they miss to store their secret phrase. And if they forget their password, then it is gone. No matter how much money you had on that wallet, it is gone forever because no one knows about it. Even Trust Wallet cannot help you recover it because they don't store the password with themselves. It is only you. So what you're going to do is you're going to click on backup your secret phrase, and you're going to see this secret phrase. And it looks something like this. Okay, a mix of words which does not really make any sense. And the way you store it is you write 3 to 4 words at one place, and in total you write at 3 to 4 different places. So even if by mistake someone gets to know a place where you have stored it, they won't know the whole phrase. They will only know 3 to 4 words. So there's no way that anyone can hack your wallet, even if they get to know where you've stored the phrase, right? So in total, there are 12 words. What you do is you store at 3 different places, 4 words each, and then no one can, uh, hack your wallet. Once you've done this, you have to try to memorize it or write it somewhere. You click on proceed, and they'll ask you to fill in all the words so that they can assure that you have learned it or you have written it somewhere so that you don't lose it. And once you do that, then your secret phrase will be recovered. So that's the way the crypto wallet works. Okay. And if you see, there are a lot of options here. You can send the crypto, you can swap, you can add funds, you can sell. So it's an earn option here, which is you can stake. But essentially, what I wanted to do today was help you make your own first wallet. And then from here on, you can search online and get to know more about it. All right. So I hope you're done with. I hope we're done with this. We will just go to our next topic now. Just give me a second. Yeah, which is quant finance. Okay. Has any one of you heard about quant finance till now, or have a sense of what it is? Anyone who wants to answer?
Maybe
What do you
it is
understand by the word quant? Mathematical analysis, quantitative. Okay. Statistics, yes. Right. So quant finance, quant essentially means anything to do with numbers, anything to do with numerics, anything that you can quantify is basically quant, right? Suppose you must have heard of roles like quantitative analyst. So what does that analyst do? He deals with numbers. So quant finance, just like that, deals with numerical finance, right? It is basically, to give you an example, suppose if I make a simple algorithm, which is buy HDFC Bank whenever it drops by 5%. That is a quant finance algo. It is a very simple algo, but it is a quant finance algo because it is based on numbers. And it is telling you that whenever HDFC drops by 5%, I want to buy that share. Okay. Now, what happens is that in finance, you're dealing with so many numbers and so much data that it becomes very difficult for a person to get a hold of the entire picture individually, right? And that is why we make use of tools such as Excel, such as Power BI, such as AI now. All right. But there are three main topics in quant finance. First is signal generation, second is alpha, and third is backtesting. Signal generation is used to define what is the cue that you're going to use to buy or sell a stock or to take any action. Okay. It gives you a signal to do an action. All right. A cue to do an action. Second is alpha. Alpha basically means the amount of return that you can generate above the market, above the index. So suppose I say that Nifty is generating 12% return and my strategy is generating 19% return. My alpha here is 7% because it is 7% higher than the market, which is the index, the Nifty 50 index. Anyone who can tell me what is the Nifty 50 index?
It is an accumulation of the top 50 companies in the stock market.
Very good. And can anyone tell me why is it called index? What is the use of having an index?
It is called an index because it shows the overall positions of the top 50 companies and the overall position of the market.
Very good. Well answered. So the reason it's called index is because just like in a book, the index tells you what are the components of that book. The index tells you how the market overall is performing, right? Because it is a mix of 50 companies. And that is why we have index in all the markets that are there. We have an index in the Indian market, in the US market, every other market. Next, we come to back testing. Now, if I come up with an algorithm that, like I just mentioned, buy HDFC Bank whenever it drops by 5%, I need to test whether this algorithm is actually generating money or not, right? If I don't do this, then I can come up with n number of algorithms and I will never be able to actually make money. The point of doing everything in quant finance or in finance is one of the two. One is either you make money, second is either you save money, right? There is no third point of doing anything in finance. So backtesting will tell you whether you are able to make money using the algorithm that you have or not. So what it does is it will collect data from the last, say, 10 years, 15 years, 20 years, and then it will clean the data. After cleaning the data, it will run your algorithm on it, and then it will tell you whether the algorithm is profitable or not. Okay. Now, there is one main issue that comes up in backtesting, which is look ahead bias. Look ahead bias is basically the issue that if I know what has happened in the future, I can very easily make up a strategy that will perform well in that future. Right? If today I know that Nifty is going to go up 5% in the next 3 days, I will simply buy Nifty now and sell after 3 days. Right? And because we are using historical data, right? We are using data from today to last 20 years. I know if I'm sitting in, say, 2006, I know what all has happened in the next 20 years. So it is very easy for me to fall into the trap of look ahead bias and then mold my strategy as per what is going to happen in the future, right? But what is going to happen from today onwards, I'm not aware of that. So although my strategy will perform very well in the back testing, it is not going to perform well actually when I deploy it in the live market. And that is why what we do is that we divide the market data into three parts. Okay. We have the train part, then we have the validate part, and then we have the test part. Okay. The train part is around 50 to 60%. The validate part is about next, say about 20% or so. And the remaining, say 20% is used for testing. Now, what is the point of this? What I'm going to do is suppose I have 20 years data. I'm going to take the first 10 years data to train my model. Okay. The first 10 years data is going to be used to train my model. So suppose I do it today from 2006 to 2016. Going to use that data to train my model. Next 5 years, I am going to use it to validate my model. Okay. So I am going to use the data from 2016 to 2021 to validate whether my model is working well or not. And based on the validation results, I am going to again improve the data and train it better. Once the training and validation is done, I am finally going to apply that algorithm in the last 5 years, which is 2021 to 2026. Now, keep in mind that my algorithm has not seen the data from 2021 to 2026 at all. Okay. And that is why it is not trained for it or validated for it. And that's why it's called a test, right? You're testing whether the model that you have made using the training data and the validation data is actually working or not. And then you finally test it and you get to know whether it is working well or not. Okay. So what is the entire loop of generating a signal and then actually backtesting it and then deploying real capital on it? So the first thing that you come up with is a hypothesis. All right. So a hypothesis can be anything that you believe is true, but you are not sure whether it is true for sure or not. Right? You think it is true, but you don't know 100%. So suppose I have a hypothesis that whenever Nifty has a gap up of more than 2%, it will go down by 1%. Suppose it's my hypothesis. Okay. What I'm going to do is I am going to turn this hypothesis into an algorithm. Okay. I'm going to turn this hypothesis into an algorithm. Then I'm going to collect the data of the last 20 years, like I said, divide it into 10, 5, 5, train it on the first 10, then test it, validate it on the next 5, and then test it on the next 5. After it performs well in backtesting, I am going to paper trade it, right? Paper trading is essentially trading without using actual capital and you just keeping a track of where the price went from where I bought and where I sold. Once the paper trading is successful, then finally I am going to deploy small real capital on it and see whether it is working well or not. This is called front testing. We heard about back testing. This is front testing. When I test it in the actual real market with small capital, and then I'll see the performance for the next few months and then decide whether I want to deploy more capital on it or not. Anything that you guys do not understand, please tell me now. Okay, hoping that you all understood everything, I am just going to ask someone to answer a few questions. Karthik Jain, are you here? Okay, I guess he's not here. Siddhi Doshi. Okay, you're here. Perfect. Okay, can you tell me what is the difference between back testing and front testing? Karthik, can you hear me? Okay, I guess Karthik is not here. Siddhi Doshi, are you here? Okay, let me ask someone else. Hitansh Gala.
Yes.
Perfect. Can you tell me what is the difference between back testing and front testing?
Backtesting is like we test something first and then implement it again. Li- uh, Like we first test the entire system and then we uh,
Okay,
officialize it.
very nice. All right, perfect. Fine. Then we'll move on to the next topic, which is now how to use AI in both these fields. Number one is crypto, and number two is quant finance. So one way in which AI is used in crypto is called sentiment analysis. Okay. Now, what is sentiment analysis? Can anyone tell me what they understand by sentiment?
Mindset.
Right? Anyone else?
Sir, it can be humans' feelings or depending upon any small news came outside the market and everyone has panicked or something like that.
That is correct. So, sentiment analysis is essentially trying to quantify the qualitative aspect of uh, how people are thinking in the market, right? So, for example, when recently when the news of war came, the sentiment was very negative, right? Because of all the projections that people had about the economy and the inflation and the increasing price of crude. And this is exactly what sentiment analysis is. You try to see how other people are thinking, or you try to guess how other people are thinking and how they are going to impact the market, right? Whether they are bullish, whether they are bearish about the market or not, right? And it becomes very tedious for you to individually go and read about what people are saying and then make your decision. And that is why we use AI for this. What we do is essentially on X or on any other platform, you can use your AI like Grok or any other platform that website provides, and study how the people are reacting to the news that is there. And by that, you will get a sense of sentiment analysis. One of the best tools that I used for sentiment analysis is called a fear and greed index. Right, I'll show it to you. Give me 1 second. So a fear and greed index basically tells you whether people are afraid of the market right now or they are being greedy. So as you can see right now, the fear and greed index is at 25, which tells us that the market is in extreme fear right now. Okay. And this is a scale from 0 to 100. So whenever it is below 50, we say that the market is in fear. And whenever it is above 50, we say that it is in greed. So I know that if I am an investor, for example, if I'm a long-term investor, I know that the best time for me to buy a stock or to go long or to be bullish in the market is when everyone else is fearful, right? So when the market is in extreme fear, that is the best time for a long-term investor to get into the market. And when the market is extremely greedy, that is the best time for me to exit, right? This is one way that this is used. Apart from that, there is something called as on-chain signals. Okay. Like I said, in crypto, everything happens on the chain. So you get to know about everything that is happening there. I can see who the best investor is on any chain. What are they buying? What are they selling? And there are a lot of platforms that are used to study who are the top performers of that chain. So, for example, if I go to a platform such as Hyperliquid, which is one of the most traded platforms in crypto, I can go to the leaderboard and I can see who are the top performers for the last 30 day, for the last 7 day, 24 hours, all time, etc. And I'll get to have a sense of what the top traders are buying or selling. Right. Next, we come to factor discovery. Factor discovery is essentially finding inefficiencies in the market that you can capture. Okay. So, for example, I know that the price of a token like Bitcoin is $100 on one exchange and $101 on another exchange. This is an inefficiency in the market. So what I can do is I can simply sell where it is higher and buy where it is lower and make that $1 difference that is there in the market. And it is risk-free profit. This is also called as arbitrage. So factor discovery is one way for which AI is used. Next is market making. Now, whenever we go to a market, right, we see that there are a lot of orders in the order book, right? Here, if you see, these are all the sellers and these are all the buyers that are there in the market. Now, do you think these orders which are being placed at such a speed is being executed manually? Of course not. They're executed using algorithms, right? And as a market maker, as a person who is making this order book or filling this order book, what I'm going to make is the difference in price. So if you see there is a slight difference in price, the price at which they're selling is 994 or a dollar higher than the price at which they are buying. So every time they execute a trade here, they buy and they sell, they are making $1 difference, right? And which might not seem big initially, but if you execute it repeatedly over a period of long time, it becomes a sizable amount of money. And considering the volume at which they are executing these trades, it becomes sizable, right? That's the next thing. I think we are slightly short on time, so I'll just cover the next topics. Next is regime detection and alternate data. Now, regime detection is basically the market follows a regime until something new comes up. All right. So, for example, until until COVID came, right? Until COVID came, there was a certain regime that market was following. After COVID came, the regime shifted, right? The market became much more volatile, and it was bearish for a very long period of time. And all the moves that were happening in the market were very fast. It was going down fast, it was coming up fast. So that was a regime shift. Then again, if you see, in 2022, 2023, the regime shifted again and it became kind of stable all the way till say 2025 till Trump came in. After Trump came in again, he made the market very volatile, first coming up with tariffs and then now coming up with this war. So that is how the regime keeps shifting. And we use AI to quantify and find out when the regime is actually shifting. The last is alternative data. A lot of data that we are not aware about is being used by smart money to navigate through the market. So, for example, one data that is being used is the number of ships that are passing from a particular port. Okay, so for example, if I pick the port of Mumbai and I say that every day 100 ships were passing from the port of Mumbai, but recently I'm seeing that 500 ships are passing. What does this tell me? This tells me that the economic activity of that country, of that economy has increased. And that is why it gives me a cue, a signal to be bullish for that economy. Right? That is alternate data. One interesting fact is, have you guys heard of this Hollywood actress called Anne Hathaway? Yes or no? Yes. Okay. This is the actress. Now, if you notice, her surname is Hathaway. Can you recall anything else that is also called Hathaway? Very famous thing in finance, especially. It is
Berkshire
related.
Hathaway.
Exactly. Berkshire Hathaway, right? The surnames are similar. Now, every time Anne Hathaway comes up with a new picture, with a new movie, and she's all over the news, the shares of Berkshire Hathaway goes up. You know what's the reason behind it? The reason is sentiment analysis. The AI algorithms that are capturing the sentiment of the market pick up on the surname Hathaway, and they think that people are talking about Berkshire Hathaway, and then they go and end up buying Berkshire Hathaway shares and the price goes up. So this is an example of sentiment analysis gone wrong. Nothing actually is happening with Berkshire Hathaway, but just because the name Hathaway is in the market, is in the news everywhere, the algo ends up buying the shares, right? So it's very important to make these algorithms precise. Otherwise, they'll end up doing something like this. Next, we come to the crypto tools that are usually used in the market. The first one is CoinGecko. CoinGecko is like a generalist tool that is used to check the prices, check the market cap, and other things of the crypto. Gives you a general overview of what's happening. Next is CoinGlass. CoinGlass tells you about the funding fee of the market, whether the market is overly bullish or overly bearish, right? Then there are similar platforms like DeFi Llama, Etherscan, CoinDCX is one of the exchanges which are used for on-chain data, right? On-chain data tells you how many people are buying a certain crypto, how many people are selling a certain crypto, what is the volume with which they're buying or selling, how many number of wallets are there in a certain network. Lastly, we come to quant tools. One of the quant tools that I really want you guys to go and check out is Zerodha Streak. It is one of the simplest quant tools that I've come across, and it has very simple algorithms that you can easily understand and work with. And it can be a starting point to a lot of things. Okay, so try out Zerodha Streak for sure. I will give you the link on the chat. One second. I've sent the link. Check it out for sure. Apart from that, TradingView is used as a charting software to check out the charts of any asset that you want to track. There is Zerodha Varsity that is used mainly as an app to learn from. It's like an ebook that you can go through. Then of course there is Python. Y Finance is extensively used in Python to get the data from Yahoo Finance. Then there is Claude, ChatGPT, of course. Check out Claude Code if you guys are using Claude. And whenever you want to be more qualitative in your approach rather than being quantitative, try using Notebook LM. So what that does is basically it turns whatever you give it into a conversation and then you can talk about it. So for example, recently Zepto filed for DRHP, right? So basically they're coming up with an IPO. Now you want to understand what's happening there, right? You want to understand what is the price that they're coming with, why are they launching an IPO right now? You can upload the DRHP there and talk to it and try to get a better sense of what's happening. Right. So with this, we are coming towards the end of this session. Any questions, please ask me. Okay, there's one question I see in the chat, which is sentiment analysis responsible for the fluctuations in the prices of the stock which sponsors any particular sports person and based on his or her performance, the price varies? Yes, of course. So for example, if you see, couple of years ago, I believe there was a video that became very viral, which was of Ronaldo keeping aside the bottle of Coke or Pepsi. I can't recall exactly. And after that, the price of Coke fell sharply. So that was a very good example of a sports person or a celebrity affecting sentiments, and then people acting uh, on those sentiments, because nothing actually happened with that company, right? Coca-Cola was still making as much money. Their margins was still the same. Their distribution was still the same. Prices were still the same. Everything was same. It was just the sentiment that a sports person or a celebrity did not approve of it, that it fell sharply. Can you explain factor discovery and market making again? Sure. So think of a factor as an inefficiency in the market that you can capture. Okay. Anything that, any information that you can discover in the market, which not a lot of people are aware about. So for example, like I told you, if you see that the price of a certain asset is trading lower on one exchange and trading higher on the other, you can pocket that difference by selling high and then buying low. So that is an example of a factor. Factor discovery is searching for those inefficiencies. Okay, so you can make an agent, make a bot that will scan the market and will tell you what are the factors that you can work on, and then finally you can backtest it, signal generate, you can generate a signal, backtest it, and then find out whether that factor is actually making money or not. Market making is trying to pocket the difference between the buying and the selling price. So here we saw this is an order book, right? It has all the prices and quantities at which people are selling and all the prices and quantities at which people are buying, right? Now, there is a difference between the best price you can buy at and the best price you can sell at, right? And this difference is what these market makers are trying to pocket. So they are the ones who are filling all these orders in the order book again and again, repeatedly using algos and AI. And they are trying to pocket this difference. So whenever you buy, you will buy higher. And whenever you sell, you'll sell lower. And that difference of a few dollars is what these market makers are going to make. Thoughts on ideas of ICT and SMC. So ICT and SMC are concepts which are used in technical analysis. Of course, we did not talk about technical analysis today. Probably we'll have some session going ahead. But of course, those are two theories in technical analysis which are extensively being used. But the thing is that after every few years, the market shifts, right? once a concept known is very well known in the market, it stops working because everyone is using that, right? If everyone knows that tomorrow Reliance is going to go up, it won't go up because everyone knows about it. So no one is actually going to act on it. You can't make any money out of it. You can only make money out of things that few people know. If everyone knows it, you can't make money out of it, right? And that is what is happening with these concepts like ICT and SMC because everyone knows it. It becomes difficult to make money out of it. And right now, finance is investment management, especially is shifting towards quant finance from technical analysis. Yes, initially there was the phase of fundamental analysis wherein people were just analyzing the balance sheets, the P&L statement of the companies. Then came the era of technical analysis for, I would say, 20 years. People were just focused on the price chart and trying to figure out what's going to happen based on the price chart. Now has come the era of quant finance wherein they are trying to use quantitative methods to make money out of the market. Is it not a point of worry about various cases of over dependency on AI causing losses to normal public? Is dependence on AI for analysis really fruitful? So, of course, see, you cannot depend on any algorithm 100%, and that is why there are a lot of manual checks involved in any algorithm that is deployed, right? There is a system called as risk management system, which makes sure that unnecessary risk or over due risk is not taken by the asset management company, and and that is something that is managed manually, right? That is not managed through an AI because the AI can always go wrong, and that's why manual checks are very important. How one can start their investing journey in crypto, and also can you please give a blueprint or complete a roadmap? So the best way to start your crypto journey is first focus on learning. Spend at least a month or two learning more about the concept of crypto, the technology behind it, why is it being used, what's going on in the market right now. And then once you have a good sense of what is happening there, then you can start your journey in crypto. And there are a lot of exchanges in the market that you can use. There's CoinDCX, CoinSwitch, there's Binance, OKX, Bybit, so many exchanges. And recently, the government has also become slightly accepting of the fact that crypto is there in the market, and um, they are accepting that that is the future. I think another bill is going to come in a few weeks or so. So once the government becomes more accepting of the fact that this is something there that they're in the market, of course it'll become easier. But even now, all these exchanges are FUI approved and RBI approved. Binance, OKX, Bybit, CoinSwitch, CoinDCX, etc. From where can we start learning like what material and also how to practice it? So of course, to learn, the best place to go is YouTube. um, Check out who are the top content creators and follow them on YouTube. Apart from that, you can also practice using paper trading. So never deploy the capital first, always go for paper trading first. Do it for a few weeks, at least a couple of months or so. And once you are confident that you're able to make money out of it, then go for actual deploying of capital, and always start with a small capital. Which is more futuristic, crypto or stock market? Of course, if you talk about the future, crypto market is what's coming up. But the thing is that the stock market is not going to stop, right? It's always going to be there. It might so happen that the stock market will get tokenized, which means that the stock market will come on chain, but the stock market is always going to be there. Okay, I think we are done with this session now. Sir, if they have any queries, they can email me. I'll give my email here.
Yes, if any student has any queries, Still, you can ask, sir.
Yeah, sure.
Yeah. Is it done?
Yes, ma'am. It's done from my side.
Yes, sir. Yes.
If they have any queries, they can ask me now, or they can also email me. I've sent my email here.
Yes. Okay. So, good evening, everyone. On behalf of the HR College of Commerce and Economics, I extend our heartfelt gratitude to our esteemed speaker for delivering such an insightful and engaging session on the future of finance, AI, crypto, and quant trading. Sir, your presentation provided our students with a valuable understanding of how emerging technologies such as artificial intelligence, cryptocurrencies, and quantitative trading are transforming the financial landscape. I would also appreciate the practical examples, industry insights, and future perspectives which you have given have undoubtedly broadened our students' knowledge and inspired them to explore these evolving domains with greater curiosity and confidence. We sincerely appreciate the time, effort, and expertise you shared with us today. Your willingness to interact with our students and answer the questions had made the session even more meaningful and enriching. I also extend my sincere thanks to our principal, management, faculty members, and all the students for their enthusiastic participation, which contributed to the success of this program. Once again, thank you, sir, for your valuable contribution. We look forward to welcoming you again for much more enlightening sessions in the future.
Most
Thank
welcome.
you all. Thank you, sir. Thank you all. Have a wonderful day. So we are just closing. Yeah, done for the day. Yeah. Have a wonderful day, all of you. Thank you, sir.
Thank you so much. Most welcome.
Thank you, sir.